Good evening, investors. We thought of creating this video for our investors to share our views on the market because we constantly keep getting inquiries about what to do from an investor's perspective. So here is a quick presentation. We are sharing our views and we'll be happy to connect with you for a more detailed conversation whenever convenient. Uh, so basically what we have seen is that the markets have been hit by three big events in the last 2 years, which have impacted markets and created a lot of volatility. The first was the COVID waves that started in March 2020, and then there was a recent spike in global inflation and the expectation that interest rates will go up throughout the world, increasing the cost of capital. And finally, the Ukraine war situation that is still not resolved. And these three big events have created a lot of anxiety for investors and created a lot of volatility in the market. And as a result, what has happened is that the Indian markets, which are one of the small emerging markets, have got further impacted. So there has been continuous FPI selling since October 21, 4 months of non-stop selling, $36 billion, one of the highest ever over a 4-month period. But the good thing is that this time, unlike earlier, a large part of this selling has been absorbed by the DIIs who have come in and invested $26 billion. Also, it is heartening to see that while the short-term FPI sellers have been exiting, the long-term investors like PE funds, strategic funds, sovereign funds, they have actually been buying and increasing their shareholding. And that's one of the reasons that despite this heavy FPI selling, the markets have corrected by barely 7-8% from the top, and not more than that. And this chart gives you a further picture of how intense has been the FPI selling since October. So where are we right now? Where has the money gone? So frankly, it's not that the money has vanished into thin air or gone back somewhere. It's the only thing that has happened is that the global funds have increased their cash position from what used to be a 5% level to almost 6% now, which is one of the highest ever. It is higher than what it was during the global financial crisis in 2008 also. So it's not that these funds are going to sit on this cash forever. The fund managers get paid a fees for making returns, not sitting on cash. So as these issues get sorted out, we expect this cash to come back into equity markets and especially emerging markets like India. What is driving this war, this flight to cash is, if you see, this is the global fear and greed index. And if you see the right side bottom, it is pretty much at its low now, which means that there is extensive fear and there is very little greed, which is driving investors' actions right now. And typically, this index bottoms out at this level. And when investors come back to risk assets, this starts getting into the green zone. What are the fears right now? One is that there is going to be sharp inflation, crude spike, sharp inflation in India also, which will lead to RBI increasing rates. There is expectation that Ukraine can turn into a World War III before it is resolved. Then there is a fear that analysts will downgrade Indian estimates. Divestment targets, LIC IPO is delayed, putting pressure on the fiscal deficit. And India is already expensive by any traditional standards. But those are the reasons, good reasons for somebody not to invest or under allocate. But here is our prognosis, what we are seeing. We think that the recent state elections have helped reduce the political anxiety a lot. People are seeing now a roadmap right up to 2024 with one stable party, each state level party, state level government being a stable government. At the national level, you have a state, national stable government, and that has quelled the political anxiety a lot. The second is that despite the sharp increase in crude prices at global level, Indian finances are strong enough that the companies have absorbed those hikes and government hasn't increased the pump prices to keep inflation under check. So this is a material benefit that we have. And one of the reasons for that is because our direct and indirect tax collections have been much better than expected and continue to be more robust as the economy opens up. The Nifty valuations also have come now within the normalized zone. There was a fear that they are higher than their average, but now they are at the top end of their average, making them more attractive than earlier. Uh, and we also believe that FPI flows will revert sooner than later because there is a limited time during which they can sit in cash, and at some point of time they would want to reverse and get into risk assets. Uh, Amongst all the global markets that we see, we believe that India continues to have the most favorable dynamics compared to any other emerging markets, largely because of its young population that is driving growth, the tech adoption, very resilient domestic consumption, access to capital. So, and it's not only us who see this in India; the global funds also see this. So, uh, and we are reading about it already. There are people, analysts, who are getting hopeful that after 4 or 5 months of incessant selling, finally we will see a reversal in FPI flows, which, when clubbed with the positive DII flows, will help the market recover and get to new highs. Uh, this is our, the last slide, our advice to our investors and advice to all our investors who are long-term investors, who are not traders, who are not tinkering with their portfolio on a daily basis. So first is, we would again say that look, stick to your asset allocation plan that you have devised by yourself or in partnership with your financial advisor. Do not tweak it. Do not go by market volatility to play around with your allocation. Very important second thing is to make sure that your portfolio has only high quality stocks. And if you have any stocks that were trading stocks, you should exit them and switch to better quality stocks. Uh, Thirdly, use this market correction to add 10 to 15% to your existing equity allocation. This is not the time to bottom fish, so don't go all out, but use this correction to add to your equity portfolio and buy stocks that you always wanted to buy but thought were expensive. At the same time, if you're under allocated to equity, then do not wait for further correction. It may come, it may not come, but use this current correction as an opportunity to fix your asset allocation to equity. And while choosing funds to invest in, go for funds that have two things. One, a very good investment track record, and secondly, a very transparent investing strategy. Somebody a fund that is communicating with you, which is sticking to its investment strategy that has already been detailed to you. And lastly, use this opportunity to churn out of low quality stocks if you have in your portfolio and get into high quality stocks. So this is our, quick advice to our investors. Rather than writing a big note, we thought it would be easier if we do it in the form of a video. And I will end it by again bringing your attention to one big data point that look, in India as a country has $3 trillion of market cap now, and which is quite amazing because that is the market cap of one single company, which is Apple. So, uh, we can be pretty sure that this 3 trillion will become 6, 6 will become 9, 9 will become 12, 12 will become 15. And we will follow the value that has been created by China, by US, and track those kind of things. But this will not be a linear journey. There will be periods of volatility. So buy quality stocks, build a solid portfolio, stick to your asset allocation plan, and then stay invested patiently, ignoring what is happening in the markets. That is our big advice. We are always happy to have more detailed discussions in a one-on-one format. Please do reach out to us, anybody in our team, and we will be happy to talk to you. So thank you very much once again for your time, and I look forward to talking.